Hey everybody. The elephant in the room that no one ever wants to talk about, and that is the concept of money and how it relates to real estate investing. We're going to highlight the unique access to capital in the United States compared to so many other countries. As someone that was born here in the United States, you don't understand the superpower that you have with the access to the type of capital that is available. Today, we're going to emphasize the challenges of funding real estate and the need for capital to fund real estate deals, the need for capital to kind of scale a real estate portfolio. We agree, David and I, that dollar cost averaging as a strategy to gradually invest in real estate over time is certainly the way to go. I share personal experiences of saving money and buying the first property, as well as that frugal mindset and leveraging capital. In the conversation, we discuss various strategies for acquiring real estate properties with minimal amount of money down. We're going to explore the concept of buying a business using an SBA loan and using the profits from that business to invest in passive real estate. We also talk about saving, renting out rooms, buying real estate creatively through like subject to strategies, through owner financing. And additionally, we talk about benefits of assuming VA loans and refinancing to tap that equity. And finally, we touch on the potential for raising capital through funds and syndications. You're not going to want to miss this episode because money is so important and it is always in the elephant in the room that no one ever really wants to talk about and they just want to generalize. So take a listen and we appreciate your time and let's do this.
You're listening to the Burn Your Boats podcast, From Hard Money to Hard Assets, a guide to real estate investment funding. And now, your hosts, Clark Lunt and David Shaw.
So everybody, the next topic of the day that we're going to talk about here, I'm Clark Lunt here with David Shaw, my co-host, and David, this is a topic we always think all the topics are important. I don't know if there's much more of an important topic than money. It's something that's scary. Everyone getting into whatever kind of level of business or real estate, money is always usually the first thing that comes up. So we felt like it was worthwhile to kind of devote an entire episode to money, the elephant in the room, why it's important, how we can raise it, depending on what level you are and what you're looking to accomplish. So David, welcome. Excited to talk about this and tell us a little bit about your thoughts on that.
It's the most important topic when you're getting started, when you are midstream, when you are a large scaled out fund manager. We all need access to capital, right? We all need a daily supply of capital. So there is no more important showstopper of a topic than money.
Right.
How do we fund our deals? How do we fund a growing real estate portfolio? And so my observation is when I was trying to unpick this Gordian's knot, how am I going to get the money to do, my first acquisition, my first long-term buy and hold? How am I going to get the money for my first flip? How am I going to do these things? How am I going to fund these things? And this is kind of before there were a lot of podcasts about this topic. And even, in the last number of years where there is a lot more access to information and data, the bottom line is that not a lot of people really talk about this topic. Talk about, oh yeah, I bought this, I did that, or, but very few people talk about like, where exactly did you get the money? Not, oh yeah, I got it from here, I got it from, got it from this guy, I got it from, but where exactly and how exactly did you get the money to grow out a portfolio? Because we talk about it every week,
right,
as if we're buying Smarties.
Yeah,
but we're not. Like we have these problems too, right?
It's funny because it's almost like a cultural thing where it's like, oh, I just bought this house down the road, or I just bought this 20 unit, right? And it's like, wow, how did you get the money? Like, who did you talk to? And I almost think it's the same thing of like growing up culturally, where it's like, hey, David, how much money did you make last year? And, you know, like if you're a kid, your parent slaps you on the wrist and says, oh, that's rude. You know, don't do that. So I almost feel like we grew up and it's like, that's the version of what it was when you were 7 years old, asking someone how much money they made last year, which is considered rude. And, you know, it's not kind of like socially acceptable. And I feel like that's kind of where it is, just the adult version of that in a way.
Yeah, it is. You know, it's funny. You know, you hear people on podcasts and they talk about, yeah, when I was getting started, I just went straight in and I start buying large multifamily. How did you do that?
Right.
Like, and they throw it out there and it's like, yeah, and they tell you how they got the deal, what kind of a deal they got, you know, how long it took them to get it, how they marketed, the broker they talked to, how they stabilized it. But so very few people say, this is how I got the capital to do it. So
Yeah.
today's episode, we're going to try and demystify at least some of this so that our listeners can understand that growing out a real estate portfolio requires capital. If you are broke as a joke, it is going to be very, very difficult for you to scale real estate. There are some creative methods that we're going to talk about today that will help you do that. But by and large, growing out a real estate portfolio right out the top requires money. And we're going to try and demystify a little bit of how these high flyers on podcasts get their money. And even kind of more importantly, when you leave, let's say, college and you start in your first job and you don't have a lot of money, but you do have a lot of time. Like, what is that person dealing with when they're like, I really want to invest, I really want to get into real estate, I want to build out a portfolio so that I can retire in my 40s. That person who doesn't have a lot of money in their pocket, but has these aspirations, where did they get the capital for their first deal? And we're going to try and deal with that. But before we get started, as an immigrant in this country, I'm Irish, I was born in Ireland. I want anyone listening to this who is born here or who has lived here all their lives to understand this. We are uniquely privileged to live in the United States and have access not just to the US financial system, but also the velocity of capital here in America. And let me tell you what I'm talking about. If I have a piece of real estate and I have a deal on it, so that's it, I go out and I hustle and I find a house that's worth 300 and I get it under contract for 200. Because the US legal system is exceptionally robust and quick, I can go to pretty much anybody. I can go to a RIA meeting. I can go to my uncle or auntie. I can go to friends. I can go to family and say, listen, I've got this deal. I need $200,000, $40,000 to renovate it. I've got this deal. And because the legal system is so robust that, yeah, I'll fund your deal. In fact, you might have several people who might want to fund your deal. Because they can put a lien on the collateral, which is the underlying house. And in the case where I don't pay those interest payments and the lump sum in the time prescribed, and I default, my lender can quickly and easily and simply and inexpensively grab the underlying collateral. So in that scenario, they lend me $200 for the house, $40 for the renovation. It's worth $340 at this point in time. If I don't pay them the $240, they're going to take the $340,000 house, and they can do this quickly. And because they can do it quickly, it allows capital to flow freely throughout the world. That's unique. It is really, really unique. In order to fund almost anything in Europe, I'm Irish, let alone, any kind of third world country or second world countries, you just have no access to capital because the legal systems are broken, they're corrupt, or they're super slow. And so like if I go, let's just say in Ireland, I find the same deal and I go to my friends and I say, hey, you know, our family. I'd say, hey, uncle, I found this €200,000 deal and I need $40,000 to renovate it. And I think it's worth €350,000. There's no way in hell he's going to give me that money, because if I default, I could thwart him for a decade in the court, the senior courts, the high courts. And so it's really important to understand as we get started here that as an immigrant, my observation is that the United States is awash with money. It's unique. You can feel it. It's like Neo when he sees the Matrix in the movie The Matrix, and you can see the lines of code on the wall. When, as an immigrant, you come in here and you see just the velocity and the flow of capital and the level of understanding from your friends, your family, the local wealthy people, your local lawyer, your local doctor, people you might know in your world. So many of them are very familiar with the concept of, oh, I'll give you a loan and I'll put I'll put a lien on here, and if you don't pay me, I'll get it back. So that creates velocity of business. He's confident to give me a loan. I'm confident to go ask for the loan. I know what the system. I can pay him back the loan. I get the deal done. The deal gets renovated. The deal gets sold. I make money. He makes interest payments. He's confident of me, and we all go forward and we do it again and again and again. It's rather unique. So as we go into this conversation about how do we fund deals, how do we get our hands on seed money, or how do we grow out our portfolio into a 20, 30, 40 door portfolio, it's important to understand right at the outset that we are living in a uniquely capitalized and a uniquely versatile environment here. And so, listeners, as you are here in the United States, please be aware that I don't know anywhere else where capital is as freely available and it's not conservative lending. So in Europe, for example, I would have to have the right accent, possibly. I would have to have the right parentage, the right lineage. I'd need to be from the right part of town. I'd want 10x capital or collateral to get funded in very many things at all. And so that just creates just conservative thinking, slow moving, static financial environment where you kind of almost don't get money from anybody until you don't need it. So as we go forward, let's talk about what is these unique things, right? What is unique about the United States, and where can we get our access to capital, Clark? So, there are so many great programs and things like that that are going to help people fund their deals. But we do want to say right at the outset, Clark, and this is very important, building a long-term buy and hold portfolio, it does require capital.
Anybody dang it.
Really?
That sucks. Well, if you thought that you didn't need any capital, then that's a bummer. This next hour is going to bum you out, David.
You don't know anyone who's built out a 100-unit real estate portfolio with absolutely no money down?
I don't. And now that's not to say that people don't go out there and say that. They say, "Oh, I've never used any of my own money." And then you peel back the layers of a little bit of the onion, and you see that maybe they put in a few of their own dollars. So
yeah, like the money's coming from somewhere. That's what I'm saying. When people say, "Well, I bought a property with no money down," well, this podcast today is about how do we scale out a long-term buy and hold portfolio. This entire podcast in general is about creating wealth, not creating short-term money. So we are not talking to flippers and wholesalers. We understand how you guys capitalize your deal. We'll deal with that in a different episode. But what we're talking about is how does the ordinary man scale out a real estate portfolio that fundamentally changes their financial future, right? So let's start out with the obvious. Clark, tell me, the hardest deal you'll ever fund, What is it? Which is it? What's the hardest deal you'll ever do?
Is the answer the 43rd deal? Is that the hardest one?
I find 42nd way harder than that.
I think we all know it's always the toughest one is the first one, right? You have to learn the most. One thing I want to go back to one thing is majority of people listening to this podcast were probably born in the United States. And so it's hard sometimes when you don't know what else is out there, it's hard to appreciate what you have, right? And as I've gotten a chance to talk to you and kind of learned about what's going on across the world in terms of financial structuring and lending opportunities, it's very cool to appreciate. I think it's important for you listening to appreciate what we have. Like we have all these government programs. We have a 30-year fixed mortgage, knowing that the interest rates are at 8-9% right now in March of 2024. And I got a mortgage 3 years ago for 3%, and that will forever be 3%, right? And that is such a big deal. And me being the antithesis of where you started in a different country and came here, and you kind of got a chance to see how difficult it was to see the velocity of capital because it wasn't moving. I've only seen it on my side, but now I'm seeing it because, we're on this podcast. We talk about burning your boats. We talk about maybe you want to retire early. I want to travel. So I love to travel. I want to buy real estate abroad. I've probably been to 4 or 5, 6 different countries. And guess what? I'm seeing it now, right? And the fact that I've been to 5 or 6 countries. I've met with all these different real estate agents and attorneys and things like that. David, you know how many properties I own abroad right now?
I haven't heard you mention any recent stays in your foreign land. No.
I'm batting 0 for 10, right? And it's because there's no access to any leverage, right? I have to pay cash, dollar for dollar, and so it's difficult. So I don't have a 30-year fixed. I have to pay all cash. It's new. It's scary. I don't have all the boots on the ground. So just know that the opportunities are here if you are in the United States and you want to start to leverage and build your wealth. So it's very important that's the opportunity, right? And you don't hear that. All we hear is, housing is unaffordable and interest rates are high and all these kind of negative stuff. This is the antithesis that you're in the land of opportunities, but you got to grab the bull by the horns and take it, right? It's not going to just fall in your lap. Someone's not going to just give you all this money without you reaching out. So let's jump into it. But I just wanted to make that point because we need to appreciate what we have. And I don't think we do. And that's okay. But I wanted to make that statement. So let's hop into it, David, in terms of you had mentioned the no money down. So where do we go in terms of raising capital to kind of talk to us about the different buckets as to, you're listening, right? But some people own a 500 unit apartment complex. Some people are renting an apartment and some people are somewhere in the middle. So talk to us about that.
Yeah, very difficult. You bring up an interesting point there is who are we talking to, right?
Right.
Because there is everybody on this podcast from quite a few people have reached out to me already and said, I really appreciate you guys doing the podcast. I have my son listening to it, and my 14-year-old son, or my 17-year-old daughter, or my, and that's, it's flattering to hear that. But we're talking to a very wide range of people here, from that, person just conceptually trying to understand why we invest in real estate, right up to, fairly sophisticated fund managers whom I know listen to our podcast. And so we try and not to get too deep into the woods on, overly complex, large commercial deals, or, we equally try not to tell people how to save money in their piggy bank, right? So we're trying to get somewhere in between. So what we're going to do is we're going to try and navigate. How do you get your first 3 deals? They're kind of hard. Your first 3 deals. So for most people, most serious people anyhow, they have a job, or they have a business, or they have access to income on some level, and they, getting that first deal more often than not can be an accidental type event where they buy a house for themselves, and they have a job, they've saved up their money, they buy that first house, right? And then they might marry somebody, a partner who's done the same thing. They both have a house. So now they have potentially 2 homes, and they move in together and they rent one. And then they outgrow the other property and they move into another property, and they keep the first 2 high quality properties that they bought for themselves. So they didn't buy them purely as investments. So then they're in, house 3, which is the first house that they bought together.
Right.
I call them kind of accidental landlords. And honestly, getting to your first 3 acquisitions, I see that a lot, as in that's how people get to their first 3.
Right.
But then they stop. They don't really get further beyond there, or alternatively, if you are very much bought into the whole concept of freeing yourself financially, how do we get to those first 3? So we're going to discuss that, from having, like you're coming at it, you maybe have your first job, you've got $60,000, $70,000, $80,000 a year income. You might have a partner that has that, but you're still you've decided, I'm going to buy real estate. We're going to walk you quickly through options for getting those first 3. Things get a little bit easier, but just a little bit easier when you get from like 3 to 10, right? We were going to talk about how you fund those deals. Because remember, this episode is about funding. Where do we get the money to do it, right? Not how do we do it. It's where do we get the money to do it.
Right.
So as you get those first 3, there are tactics and methodologies and discipline that we can implement to get from 3 to 10. And when we get, 10 acquisitions under our belt and, time is working on those 10, believe me, 11 to 20 gets way easier.
Yeah, it does.
Then 20 beyond gets slightly more difficult again. And so we're going to talk about, 1 to 3, 3 to 10, and then scaling out commercially, right? So how do we get from 10 to 100? So essentially that's what the podcast is about. But remember, it does require capital to own and scale out life-altering real estate, right? So our journey has been, Clark, our journey is entirely dominated by this conundrum. We had a meeting yesterday with our lender.
Yeah.
How long did that meeting go on for?
It was a long time. Yeah, because it's so important.
Right.
It's kind of the first step.
So what kind of terms was he offering us? So we were just, if you're listening, we were looking to, we're doing some new build, urban infill, where we're buying smaller homes, we're scraping them, and we're building single family homes at the front and, additional living units at the back of our lots. And so, it's quite capitally intensive. So we got to go to a lender, right? We're going to run out of money at some point. So we go to a lender, and Clark, he is offering us 65% loan to cost, not loan to value. Would that be fair?
That would be fair. So just so people, when you're listening to this, loan to cost, loan to value is, let's say we buy a property for $300,000, we put $100,000 into it, right? So that's $400,000 of cost. Well, let's say we it's now worth $500,000 because that's what it's worth in the market. So we are getting 65 cents on that $400,000, not the $500,000. So there's always going to be challenges. So that's why the good and bad thing about this is that although it's easier for us to go out and get money, at the same time, as you grow, you have new challenges, right? Because now it's like, how do I buy and build 10 houses in the next 6 months, right? Well, that's challenging because I've never built 10 houses in 6 months, right? So it's like each time you're going to face you're growing, right? And you're trying to conquer new challenges. And then when you get to 10 houses, it's like, okay, then how do I build a 50-unit apartment complex, right? So this topic is so important, and it doesn't matter whether you're starting, whether you're 50 years old or 20 or 70, or you're building apartments, or you're building warehouses, or you're buying your first property to move into. It's always going to be a challenge, and you always have to be thinking on your feet. You always have to be creative, and you have to be able to keep up with the times, because there's always going to be, like, the interest rates are really high right now. It's forcing us to pivot. It's forcing us to think again and figure out, well, instead of just building David just mentioned that we're putting an additional dwelling unit in the back, a separate unit. Well, why are we doing that? Well, we got to kind of build two houses instead of one on the same property, right? Sounds like
Yeah.
it's a little bit more work. There's more with the zoning. There's more stuff. We're not just doing that because we like to give ourselves more brain damage so we can manage more things and have more things. It's because the climate that we're in, it's forcing us to think again, think outside the box, and get to a place where we can have two rental properties instead of one on the same property, which enables us to compete with the interest rate to where it makes sense. So that's just one of the things that we are doing, but it's a challenge. And when you get a lender that says, "Well, I'm going to give you 65 cents on your cost," where's that 35 cents going to come from, David?
I wish it was 35 cents, Clark, but our build cost, our lot acquisition cost, and our build cost for that product was $605,000, and he would give us essentially 65% of that. So it doesn't take a genius to figure out that's well in excess of $200,000,
right?
That we need to come up with, right? So per deal, right? So you get one done. You give them $200,000 and you leave that in the deal. Well, what happens if you want to do 5?
Right.
That's $1 million. Now, where are we going to get $1 million from?
Yeah.
Right. That's what this podcast is about. But you don't get to even have these conversations with commercial lenders unless you buy your first deal. So we're going to start right there.
Yeah.
As we begin, so we are talking to that person now for a couple of minutes that is starting out investing. Know that you need some money. Know that there are some tactics that we're going to discuss in a minute. And also, it's very important to me that, not everybody wants to scale out to 100 units. For me personally, I'm pretty conservative and I'm not the most ambitious real estate investor out there. I don't want to have $1 billion, $10 billion portfolio. I don't want all that responsibility. I want to focus on life. I want to focus on taking my summers off, spend time with my kids. So it's really important to me that real estate for me is not a net worth number. It's not like, I want to be worth, 10 million or 20 or 30 million, 50 million, whatever the number is. Real estate is not that for me. Real estate it gives me absolute optionality. If I want to work or if I don't want to work, if I want to plug in for a couple of months and, do some intense focus work, or if I want to step back and say, I'm just going to take a little time out. I'm going to read books. I'm going to think about setting up a podcast. And so real estate for me might be very, very different than what real estate is for you or for you listening. We all have our goal. And, we talked about this before. We're going to do a very clear episode on setting your mindset and goal setting. Then what do you really want to achieve? So for me, I don't need to achieve, stratospheric success. My ego is not attached to finances. I'm far more concerned about lifestyle and those things. So when I talk about getting started for your first 3 and then getting to 10, that can really that can give you that lifestyle. Really genuinely, it can, if you buy the right assets, you can be job optional. And then essentially that's what burning your boat is. That you get to the point where you're job optional and you can turn around to your boss. Some people use the word, FU money. I don't like the term, but you can burn that boat knowing that you've got you've got your little dinghy here and you're good to go. So with that being said, I'm a firm believer in dollar cost averaging, okay, into real estate. If you are a beginner and you're starting and you want to create the life I just described, the very best way that I know how to do it is always be buying, stop timing the market, and dollar cost average your way into real estate. Buy and be very, very clear about buying a deal. And for me, it's not a door. It's like try and buy on your very first year where you decide to buy real estate, try and buy a $500,000 asset. So try and save $100,000. Try and get $100,000. Try and save $100,000 and buy that first deal. And then next year, repeat that process. So try and save 100,000 again, or get 100,000, or creatively buy another $500,000 asset, which we're going to talk about some methodologies in a minute to deal with this. And then on year 3, do it again. Don't listen to the news or markets going up, down, or sideways. And then after 3 or 4 iterations of this, you can then start to think about every year adding $1 million. So let's say 2 $500,000 assets every year. And then if you kind of do that dollar cost averaging with discipline, if you do that for 10 years in your 20s or your 30s, you've fundamentally changed your life forever, right? What do you think about that whole concept that I'm quite adamant about, as you know, because I personally do it. And so I'm not out there saying, oh, I bought 500,000 units with other people's money. No, I dollar cost average myself. So and I know you do too. So what do you think about that as we get started? Like just dollar cost averaging. You don't have to, change the world, but just dollar cost average into real estate.
So I'm listening, and you said, well, 500,000 to put down 100 grand, right? And we're gonna get to this fairly shortly. Is like, what if the listener is like, I don't have 100 grand just laying around, right? And then I also don't have another 100 grand on my $75,000 a year job to buy another property for 100,000. So we're gonna get to that, and we're gonna give you some ideas for that, which is cool. I tend to I certainly agree with you. I think ignorance is almost a good thing. And the fact that like ignorance is like, I think it's a good idea to buy real estate and I want to live in it. So just go buy your first house, right? And stop analyzing everything, analysis paralysis. And if you only buy a $250,000 house, that's still a huge win versus just renting your property, right? So don't overanalyze, knowing that you can't get to the 10th property, the 20th, the $100 million apartment complex until you buy the first house, right? And if you don't buy that, if you keep delaying it, if you keep making excuses, you keep saying you blame someone else, pointing it at the market, pointing at this, pointing at that, pointing at inflation, you're never going to get to that second and third house. So 1,000%, I know, and I can speak to it because it's what I did, is that I just bought a property with no analysis. My first one, my second one, my third house. I bought my first 4 houses before I ever technically bought an investment property, which was solely for that purpose, which is you buy a property that you actually don't live in, and then you fix it up and you stick a tenant in there, right? So until I got to my 5th property, the first 4 properties I ever bought, I bought it because I could afford it, and I was cool living in that area, and the conditions seemed okay, right? And then I bought my second one, and I was like, I bought it because the neighborhood was okay. Again, I could afford the mortgage. That was it. Like that was my analysis. Can I afford the mortgage? And do I have to sleep with a gun underneath my pillow every night? No, done. I'm buying it, right?
Well, to the point of the episode, where did you get the money for that very first deal?
So this is you're about ready to hit the snooze button, David, because it's gonna be super boring and it's not exciting.
It's not meant to be.
I actually saved money on the first house, the 20%. Now, I know that is not some cool strategy I did where I did a deal with someone, they gave me the money, and then we did some crazy thing. I saved the first 7 houses that I bought in my first 10 years. Okay, so from 2006 to 2000, basically like 14 or 2015, I bought 7 houses. I would buy one, I'd save up 20%, and guess what? I would just work my ass off some more at my job that I was trying to get better at. And then I would move out, buy another property, save up 20%. And I did that 7 times before I ever used any ounce of creativity, before I ever used a hard money lender, before I ever used other people's money. I went to a bank. I had pretty good credit. I had a stable income. The bank, the banks liked me more then, when I had a stable W-2 job, than they probably do right now, right? Like now I show them this, and it's like I'm self-employed and my income is great one month and not great the next month, and it's all over the place. And they're like, oh my God, they'd rather me work at McDonald's making 35 grand a year, because it's like, oh, I get it, right? Like you're safe and secure. So ironically speaking, sometimes it's easier those first few deals if you just work a normal corporate W-2 job. So I know that's boring, and it's not some amazing story, but I saved money. Okay. I worked hard, and I bought a house, and then I
And what
did it
age were
again.
you? What
I
age
was
were you when you bought that first house?
So I knew that buying real estate was a good idea. So I graduated college when I was 22. I graduated in June. I bought my first house the following April. So within 12 months of me getting out of college, I bought my first house. And then 2 years later, I bought my next house. And then another 2 years later, I bought my third house.
So it took you about, let's say, 5 years to buy your first 3 deals?
It did. It took me about 5 years to buy my first 3 or 4, or probably 3 deals. Yeah. So I lived in each one of them for like 2 years. Like I lived there. I painted the walls badly. I tried to fix up things badly again because I'm not handy. But it did make it a little bit nicer. And that's how and I brought roommates in, and I've talked about this in the past, and I'll talk about it in the future, is that I wanted to keep my expenses low as possible. So I always put roommates in every spare bedroom, and I would have rented out the freaking couch in the living room if I could have got someone to sign up for it. So
we're going to get into that.
Yeah.
I would echo that sentiment. I think that it is a common trait among real estate investors that they are frugal and they have a different view of money, and that they are aware that they use the money that they do have to create investments that throw off capital, and then they can waste money. All right.
Right.
So if you're out there and you're in your 20s and 30s and you're living in a luxury apartment downtown, eating in restaurants every night, I love that lifestyle, but I would fund that lifestyle from my investments. I want my investments to fund that lifestyle, not my W-2, because my W-2 income and large bonuses. So if you get a bonus from your W-2 income, or if you ever get large cash injections from, inheritance, or you otherwise come across lump sums in your 20s or 30s, trust me, please, I implore you, take the capital and leverage the hell out of it. So I'm going to give you like a brief example. So when my mom passed away, she didn't leave an awful lot, right? I'm one of 5 siblings, and this was Ireland, right? But I took that small, meager amount of money, and I leveraged it to the hilt, right? And I have a property, and I call it Nana Doreen's, in honor of her, because she loved education, right? She was an educator. She was a headmistress of a school. And so that property that I took the inheritance from her passing will pass on to my children, right? And it's so important to understand that when you do come into money, don't put it in your bank account, in my view. Take it, put it into significant pieces of real estate, and leverage the hell out of it, and sit and wait, right? That's a debt by time by scale. So if you're having problems saving, right, you look at your own lifestyle for a start, right? Clark, that's very inspiring. You were living in Gainesville, not like you were working in Wall Street, but many people in their 20s or 30s, and I know this because I lived in these places. I lived in San Francisco in my 20s. I lived in New York City in my 20s. I've lived in London, and, they are primarily very, very, very expensive places to live, where people are starting out in their careers, and they get stuck in these places. They get stuck in this renter cycle where they're renting, and they don't want to really sacrifice where they're renting. They want to be in Manhattan, or they go to Los Angeles, and they want to be, in a bougie neighborhood, in a bougie building, and they're using their W-2 income to fund that lifestyle. It's going to be very hard for you if that's your approach to money. It's going to be very hard for you to be a real estate investor, because almost all real estate investors I know, and this, it's comical, and because I know a lot of real estate investors that are very, very wealthy, and I'm talking, 100 millionaires or more, and they're still driving around in the banged up cars, and they don't wear fancy clothes, they don't go to fancy restaurants. They can afford this stuff all day long, but it's just in their DNA. Is that they don't need, their ego is not attached to flashy watches or flashy houses. And these guys might own, our girls, they might own, you know, hundreds of buildings, and yet they still don't live that lifestyle. I think they should. At a certain point, they need to reap the rewards. But if you get a large cash injection, please, use that for to leverage. Now, look, you can work and save your way to your first 3 homes. If you're fortunate, come into a lump sum of some sort, be it a bonus, stock options. Take that and leverage it with a bank and put it into real estate. But Clark, we're both pretty passionate about the following subject we haven't talked about yet, is the concept of buying a business, using an SBA loan and buy a business and then use the profits from that business to get going on your real estate portfolio. Do you want to talk to listeners really quick, what the strategy of buying a small business with an SBA loan is? Now, you're going to need a little bit of capital. But
Right.
if you're buying a piece of real estate, you're buying it for 10, 20 years from now. You are not buying it for cash flow today. But if you want to supercharge your cash flow, save up, buy a business using a 90% SBA loan, and instead of getting 5 or 6% return on your money, cash on cash in real estate, because real estate doesn't give you all that much income today. It gives you a ton of income in the future. It gives you a ton of tax benefits now, and it gives you untold wealth in the future. But real estate is a future-proofing product, right? It's not a now product. It doesn't make you feel better now. But you know what does? Go save up and buy a business with a 90% SBA loan. Clark, what's your thoughts on that?
Yeah, it's something where, again, you're getting into something where you're leveraging something other than your time, right? Like you're talking about the person that's just getting kind of caught up, keeping up with the Joneses. Maybe they live in a high price area, San Francisco, Manhattan, wherever. And it's like the only way for them to really make more money or get ahead is to either work longer hours, maybe make more calls, bring in more accounts, whatever that looks like, work smarter to be able to grow the corporate ladder. But again, it requires all of your 100% of your energy, right? So on the business, I've watched this my whole life with my parents, where my dad was in sales. He was in sales management. He was always very successful. But it was always dependent on him, right? Him alone to be able to grow his salary, grow his accounts, grow his commissions. And on the last 10, 12 years of his kind of working career, him and both my parents bought a business with an SBA loan with 10% down. They used the 10%, through the money that they had saved, and they probably 5x'd their retirement just because of buying that business, because now they were leveraging 20, I think the company probably had 20 or 25 employees. And they were able to leverage 25 people out there, swinging for the fences every day, to create a lot more cash flow a lot quicker than he would never been able to make that enough sales or manage enough people within a company that he worked for. And then he was dealing with a lot of politics within the company and all that kind of stuff. So it was like he was able to control his own destiny. So I got to watch it firsthand, front row seat, watching someone that had been successful all his life, but being able to buy a business and leverage it on that 10%. So if we went back and looked at the 10% he probably put down, let's just use round numbers. Let's say the company was $1 million and he had to put $100,000 in. That $100,000, oh my God, it probably 25x what it did, and it provided them. Now they have a great retirement, and they get to live where they want to live on the water, and be able to be financially free. And that was through that investment. But there's a lot of blood, sweat, and tears to be able to save up that $100,000 to get to that point. I bet you if we had my dad on this podcast right now, and we said, going back, getting into a time machine, do you wish you would have done that investment at, let's say, 45 instead of maybe 55? I think we all know what the answer to that question would be.
That's right. And you also told me concurrently, your parents, they bought a business, but then they bought the premises on which the business operated. And when they exited the business and they exited the premises at the same time, that the profits from the business, like the sales price of the business, made them X dollars, and the sale price of the physical real estate in which they conducted their business made them X plus dollars. And so the business paid, the point of owning a business is it pays your today
Right.
needs, right? So
Yeah.
it covers, it allows you to save up, that business allowed him to buy the commercial premises,
Right.
and the commercial premises then didn't have any return over the years, other than the fact that he worked in it and he paid off the mortgage through the business. And then when he came to sell the commercial building, he made himself a small fortune.
Yeah.
And so, again, to highlight the point, real estate returns generally in your future, you are deferring gratification today. So this episode is about where do we get the money so that we can build out a real estate portfolio. We're dealing right now with the first three houses. Surprise, surprise, a great way of doing it is saving. A great way of doing it is taking any kind of lump sum that comes into your life and using that carefully, right? But it's important to understand that you have to defer that gratification.
And
But
and
then
also too, David, just one thing. So saving, deferring the gratification, and freaking leave your ego at the door. Stop worrying about what everyone thinks about your house. Stop worrying about how cool that picture is of the new house you just bought and say, hey, I just bought this. Stop worrying about that.
Yeah.
No one cares about that in the grand scheme of things. And if you're so worried about having the nicest house of all your friends group, you're just never going to buy it, because that apartment that you can get into does look really cool with that view of the pool. Leave your freaking ego at the door. And it's because that ego is costing you so much money.
I could not agree with that more. I have a very detached ego from, what my outward, appearance is in terms of what I think, how much I care what other people think, if I'm successful or not successful. What I care about is when I wake up in the morning, do I have financial anxiety or not? That's really what I'm thinking about. I'm not thinking about there's over 9 billion people in the world. I can't spend my time worried about what they're thinking. And they're all having 100,000 thoughts a day. Other people, trust me, other people are not thinking about you, right?
Yep.
We're all on our own in here. We come out alone, we die alone, right?
Yep.
And so live your life for you and create financial freedom for you. But if you're having problems saving for that second house, so let's say I think most people have the capacity to work and save for that first house.
Right.
Okay. Let's say most people have that. And we're going to walk through some tools that they don't really have to save all that much to get that first one. But then you have the first house. Let's say it's in a nice neighborhood. I do this, right? If you're having problems saving up for that second house, rent out a room in your house. I converted my garage, right? And this is bonkers. In the last 30 days, my garage, I put like stuff in it, right? My garage has rented for over $6,000 in the last 30 days. My garage.
That's crazy.
Honestly, and I am not kidding when I tell you this. A year and a half ago, possums lived in my garage. If you don't know what possum is, it's like a badger-sized, dog-sized, wild animal. And we're living in my garage because I just never used it, right? So I got a contractor in here. We, made it nice and blah, 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 blah. And in the last month, because we just put it on to, like, let's see if it would make money, $6,000. So if you are living in a house in a nice neighborhood, go try rent your house out on a short-term basis and see. Let's say your mortgage is $5,000 and you can pull in 14,000. That's quite a delta. So during COVID, I went out to Idaho. I brought my family to Idaho, and that lifestyle cost me $5,000 a month. And I rented out my house, a house in downtown St. Pete, for nearly $15,000 a month. And so while I was being paid to go ski, with my kids, a delta of 10,000 a month. Had I stayed there for a year, I would have had a down payment for my second house. My point is that rent rooms, rent your garage, rent a parking space outside. Just look at everything that you've got, and you'd be surprised how much you can generate to get that, that second down payment. But then, so your first 3 homes, I think we've agreed. You're probably going to have to save, probably going to have to use leverage, think about buying a business. And then when you do own your first house, think about rent rooms, Airbnb it from, if you're not using it, if you're going away for a month or something like that, Airbnb it, right? But there are ways then to get to, from that first 1 and 2 to really getting to like 10. So first and foremost, it's important to analyze, just team up with your friends and team up with your family and talk about real estate and say, hey, listen, guys, I think I can find the real estate, or I think I've got the time to do this or the time to do that. And you'd be amazed how many successful people are in your life, right? In your friendship group, in your family group, that don't have time. They want to invest in real estate. They have lots of capital, but they don't have the time or the energy or the inclination to do it. So if some, enterprising neighbor, enterprising friend, or enterprising family member were to come to me and say, David, I found, this deal, I'd like to buy it. Do you have some money so we can put it down? We can take it down with, this type of loan, and we can own it for 10 years. Would you fund that deal? It's amazing how many people will want to fund that deal with you. Like, it's not even that you're asking for a favor, you're doing them a favor. Team up with friends and family every single time. Is that right, Clark?
Yeah, and I'll even take the let's say that all my friends and family are broke. Like let's say I'm making $60,000 or $70,000 a year, and I am the cream of the crop of my network, and everyone else has no money, and it's hand to mouth, right? So at that point, it's like, okay, I don't have any friends or family within my initial network, my comfort zone, my friends who I'm going to hang out with to go watch a football game or have a beer at a happy hour, right? So it's like, okay, then let's think differently. Let's think outside the box. So how do we do that, right? So if I were to say, okay, I want to buy a $250,000 house, and I'm going to put down, say, 10%, and I'm going to move into it, right? So that's $25,000, closing costs, let's call it 30 grand. If I were to go and say, I'm going to put together a business plan where I need 30 grand, okay? It needs a little bit of work, and I say, okay, I'm going to go and I'm going to paint the house, and I'm going to bring some value to it. And in 3 months, I'm going to save up the money for the paint. And then in another 3 months, I'm going to put in new floors or whatever that looks like. And it's going to cost X. Okay. And I went to a real estate meeting and I said, all right, everybody, I stand up. I'm Clark. I need $30,000. Who wants to lend me $30,000? And I have a nice business plan where the mortgage payment's going to be $1,868 a month. I'm going to give you 12% on your money. Okay, which is going to be a total of $2,200 for my total payment. I already paid $2,400 a month in rent for the last 3 years, and here's where I paid that. If you bring all this data and this business plan to someone, there's going to be someone there that's got an extra $30,000 sitting in a bank account, not earning 12% a month. Okay, so the thing is that you have to get outside of your comfort zone and be uncomfortable. The more comfortable you are, the less opportunity you have. And I understand it's not easy for everyone to stand up and say, guys, I don't have any money. I need 30 grand. I need to get in my first house. Again, but if you leave your ego at the front door, it's not a big deal to say I have no money. But saying I don't have any money and prices are too expensive, there are ways to get to where you want to be. But you have to get off your ass. You have to think outside the box. You have to spend some effort to put together a nice little business plan. If someone came to me and said, I need 30 grand and all those different things to de-risk my investment in that person, you only need one person to say yes, right? It may not be your first or second or third person at that real estate meeting. Maybe even, David, you have to go to a second meeting or maybe a third meeting, right? But again, you're listening, you have no family or network that has any money. There are people out there with money, but you have to put more work into it. Does that kind of make sense?
Yeah, that's right. I think what you're alluding to is what we talked about at the top of the conversation. there's, endless amounts of money around. So if you are having difficulty funding your first purchase, go house hack, right? Find a property in your local area that needs work, and duplex or something like that. Buy the property, and then not even buy it. We're talking about the money side of it. Take that deal, get it under contract, and take that deal and go to a local real estate meeting, because guess who's in the meeting? There's loads of lenders, and they're looking for people to walk in the door. Yeah. That's what they're looking for. And so funding that first deal can be, and a first acquisition is so simple in that environment, to your point. And then, you can equally house hack your way there. You can buy a property that needs some work. You can go find a property that needs a lot of work, go to a RIA meeting, or go to friends and family and say, look, I bought this property. It's going to take me a year to stabilize it. And at the end of that year, we can refinance it, or dare I say, sell it. And if you do sell it, or if you do refinance it, then that can be the seed capital, if you will, for your second deal. So, Clark, you know a lot about house hacking, but you also know a lot about subject to. So, do you want to talk the listeners to acquiring homes using subject to?
Yeah, I don't want to turn this into we could spend an hour talking on subject to, or we spend actually a lot more time than that.
Just quickly,
I'm just going to give a quick overview. Is subject to, it was the 2023 buzzword for every wholesale deal that came across my desk was a sub to. And basically what that means is that I'm able to, Sally Seller owns a home. Sally Seller got a loan in her name for X amount, and I buy the property at whatever you agree to, and I actually take over payments on Sally Seller's mortgage, and it stays in place. So I'm the new owner. My name is on the title. So if you look up the 123 Main Street and the property appraiser, my name shows up, but the debt is still Sally Seller. So every time I make a payment, her credit gets helped, or it gets hurt if I don't make that payment, right? And so it's a strategy to use where a lot of houses that maybe aren't selling, a lot of real estate investors target a house that's been sitting on the market for 3, 4, 5, 6 months. It's not selling. They can't drop the price any because the mortgage is actually higher than if they drop the price. So they need to sell it for that number, and it's just probably not worth that. You have the ability to say, hey, look, how about I just take over your mortgage? Maybe I don't even give you any money. And I just pay closing costs. Maybe I help to pay the realtor's commission or something like that. So you can usually get in for potentially low 5, 10, 15, 20, 25 grand, whatever that looks like. And you get to also take over that interest rate, which is probably going to be lower than 7, 8%, which is what the interest rates are now. So that is something that you can certainly look into. But again, David, it's not easy. Like, a lot of realtors don't understand it. They're scared. There's risk to the seller because then they have to trust that you're going to make payments over time, whether or not you're renting it out, or if you had a bad week at, you're a bartender and no one came in that week and you didn't make enough money, the seller has to trust that you're going to make those payments. So it's not super easy, but it is a method to be able to get in. And we've done it, both me and you together. And I've done it prior to us being together multiple times, and it's worked out really well. And it's something that you should probably do more due diligence on, because it's not quite as simple as people make it out to be. But it's certainly a strategy to go try and get a 4% interest rate on a loan that's been in place for maybe 3, 4, 5, 6 years.
Yeah, but staying with the subject in hand. So we'll walk through a quick subject to example. So somebody bought a house, 3 years ago for $300,000, and they have a outstanding $260,000 mortgage. Okay. Right. And so there's $40,000 of equity, and the people they want their equity, right?
Right.
So in that scenario, they're going to allow you to take over their $260,000 mortgage at 3%, which is great. You're going to have to come up with $40,000 of equity to give them, because that's, if they'd sold a house, that's what they would have collected, right?
Yeah.
So you still, again, you need that 40,000. Yeah. In order to make that sub 2 deal happen. And so you hear this all the time. There's a lot of big personalities out there talking about sub 2, it is a great way to buy properties with, little or no money down. And there's some very, very, creative ways, if you will, to make that happen. But they're really rare. You will, again, if you're looking at a subject to, and you want to take over somebody else's low cost mortgage, you're going to need a little bit of money. You're going to need 40, 50 grand to buy out their equity, right?
Yeah.
And then we got another very similar scenario called seller financing. And so there's a lot of particularly older folks out there. They own real estate. They want to sell it. They want to get it off their hands. But if you give them, let's say, $400,000, then they've got $400,000 in their bank account. And believe it or not, that actually creates an issue, because that creates a big tax event for them. Okay. And but then they don't have any income, right? So they have $400,000, but then they're going to have to invest it somewhere in a T-bill or something like that. And so they will have realtor fees, they will have seller taxes, they'll have capital gains on their transaction,
Repairs,
and then
inspection repairs,
and all that. Yep. And then at the end of all of that, they get their money, minus all the things we just talked about, and then they have to find somewhere to put it so they can make an income. Yep. If you can go right to these people at source and say, listen, you create a mortgage, as in the owner becomes the lender. I'll put $50,000 down, and you carry $250,000 loan, and I'll give you $1,000 a month from the rent. And all of a sudden, these people are like, so hold on, I don't have to sell my home. I get $1,000 a month in perpetuity. I have no tenants or toilets, and I still have, and then this debt gets paid back to me slowly over the next 10 or 15 years. So I've created an income for myself for the next 15 years. Sounds like a great deal. So seller finance is an awesome way to get yourself from, that third, fourth, fifth deal. But again, you're going to need, in that scenario, nobody's going to let you walk in their house for free, right? They're going to want 40, 50, 60,000. They don't want to sell their house, but they still want to buy that little boat, right?
And two, here's where they will let you walk into their house for free. And I see this a lot, is the house is in shambles. And they're like, yeah, just, I don't want to have to make any repairs. I don't want to have to worry about squatters moving in. So yeah, take the house. I want my price. So you'll get your price. You'll get zero down. But now you own a house that's in shambles, right? So you have to put it back together, right? So even if you don't have to come up with money on the front end, you still got to fix it up on the back end. So nothing in life is free, right? So no one is just going to give you a perfectly well-presented house with zero down that, you're making them a payment of $1,000 a month and it'll rent for $3,000, or the owner would just do that themselves, right? So it's either pay me now or pay me later, right? Either it's well presented and you give them a nice down payment. And look, I know we're going to get someone that's going to respond to this, David, says, I got the one that you were talking about. It was well presented. I got it for zero down, and the seller sends me a free steak dinner every month. Of course, there's that unicorn deal, but we live in the real world where 97% of these deals are going to be either you're putting a higher down payment down and the house is in good shape, is in a good neighborhood, all that stuff, or you're in the middle of Detroit, you're getting a house down for zero down, right? And you're paying probably a little bit higher price point, and now you've got a $80,000 renovation on your hands, and it's probably going to be in a lower quality neighborhood.
Yeah, very interesting. So again, you're going to need some money to get that.
Either way,
you're going to need some money to get that done, right?
Yep.
We mentioned that those are strategies, seller financing, subject to going to a RIA meeting to raise capital for those first few deals. A great other strategy is assumable VA loans. So if you go into Zillow, and in the keyword section of Zillow, like look at all the houses in your county, and in the keyword section, type in, instead of furnished or water view, type in assumable VA loan, and you will find that there are a ton of homes that you can walk into right now, and you do not have to be a veteran. but you can walk into a ton of homes now that are being sold by veterans where the VA loan is transferable. And again, you will still need the gap. So if the veteran's mortgage is $200,000 and he's selling his house for $300,000, you might be able to walk away with that, transferring that $200,000 loan into your name. You're going to need good credit. Yep. You're going to need to be in good standing. But you're also going to need to have that equity. You're going to need to have that 100,000. So there we go again. Like this concept where you just don't need money. Maybe in that scenario where you got a nice VA loan, maybe you team up with a family member, maybe you team up with a buddy, to get you into that house. But there is assumable VA loans is a really great way to get from 3 to 10 homes. You can do that with a group of people. It's it's very, very interesting. But look, there is so many government loans out there also. And there's like from FHA to Fannie Mae to USDA to VA. And that's just to name a few. So if you go to govloans.gov, right? So govloans.gov, or you go to the USDA.gov website, or just go to USA.gov and go to their home loan tab. There are a lot of programs with very, very low money down options to acquire real estate. So again, that's one of those unique privileges. We have a 30-year fixed with a very high velocity of money in this country, but we also have just a whole gamut of government funded loans that are available to you with as little as 3% down. So if you've got the tenacity to, on your first deal to save, let's say $9,000 and maybe $1,000 or $2,000 for closing costs, that might get you into your first $300,000 home. You stay in that home for 2 years and then you buy your second home with it, repeat that process. So don't be under any illusions that there is just, the finance side of it is so easy to get your hands on. You have to keep a clean record. You have to be have good credit, but you're always going to need, and don't really have that many people tell you that you don't need that, that down payment. And so getting those down payments is hard work. You're going to need to have a well-paid job, or, I hate the word side hustle, but buy a business and always be investing your profits into real estate. And that's what I did. That's what flipping is. Flipping is not, flipping houses has no relationship to being a real estate investor.
Right. I love these.
Not at all. Flipping houses is simply a job. It's something you buy, you renovate, you sell, you make a profit, you pay taxes on it, and you repeat the process. And the day that you stop flipping is the day you stop making money, right? The day you stop showing up for your job, or the day you get fired, or the day you just don't want to go anymore, is the day your W-2 income stops, okay? And so we all have to, every real estate investor I know has to earn money continuously to invest further. So it's not like you buy one house and then, you use the equity for this house to go into that house. And I do know a lot of people. It's a great way of getting really from 1 to 3, you just have to save your way there. From 3 to 10, you can use these creative methodologies, the owner finance and this, but you're still going to need 50 grand here and 20 grand, 30 grand and all that kind of stuff. Right. And then 10 to 20, you can then start to think about refinancing your portfolio, because now by the time you've got your first 10 homes, probably 5, 6, 7 years you've been at it, and there's some equity now in these deals. And so when you want to try and get from, house 10, 11, 12, you could start looking at house 1, 2, and 3 and say, well, I bought that for 300,000. The loan on it is now 200,000. It's worth 550. There's $150,000 of equity over there. The rent has gone up in that period of time. So now if I, quote unquote, tap that equity. I take that 150 out. I'm going to increase my mortgage expenses on house one, right? My mortgage has gone up because I took more money out of it. But so did my rent. So my rent, I'm still quids in on unit one, but now I've got $150,000 that I can put down on that, quadplex as unit 11. And so as time goes on and inflation, appreciation, and rents rise, then you can start the portfolio itself starts to self-fund itself.
Yeah.
You no longer have to kind of save your way to every dollar that you need to put down on your 12th or your 13th or your 14th deal. You can pretty much tap the equity from your first, second, and third deal. So it's important to understand that, when you hear of somebody who owns 20 homes or indeed 30 homes, they're probably not saving anymore each time they want to buy a house. They're just looking at some equity in a different house, and they're literally grabbing that and they're putting it on a new house, and the new rent on the property they took the equity out of is being used to service that new loan. And so the first three, sometimes the first one can be quite easy because it's for yourself, right? Then getting to those first three, you just have to save your way to them. From 3 to 10, there's a lot of creative ways that you can acquire the debt, or you can use your golden eggs that we talked about in the last episode, but you still have to save. You still have to team up with people, save, and otherwise defer your gratification. Maybe don't live in the fancy neighborhood for those first 10, right? And so then when you get into you've satisfied your own personal desires, 20 well located, high value pieces of real estate held over 20 years will free you financially if you have a reasonable lifestyle. You're now job optional completely. So when you think about that, like the first three are hard.
Yeah, they are.
The second six are, you can start saving up the cash flow maybe from the first three. You've had 5 or 6 more years of savings to get into 4, 5, 6, and 7. And then by the time you're 8, 9, and 10, you're using the equities from 1, 2, and 3, and then you can get to 20. Like, this is not rocket science. It just requires that we save or use any lump sums very diligently as early as we can in our lives. But then we get to another almost breakout phase where if you want to get from 20 to 100 or to 1,000, that's when we start really using other people's money. And we start setting up funds and syndications where you are now an expert in buying real estate, holding real estate, managing real estate. And at that point in time, you can start offering your knowledge and your services to other people who are otherwise too busy to do these things, or they lack that expertise in doing these things. And so you can fund 1,000 deals essentially by raising capital. Clark, what do you have to say about, now this is not a beginner strategy, of course.
No.
What do you have to say about that? Raising capital in a fund or syndication or a JV. What do you have to say about that?
Yeah, I liked your summary of like 0 to 3 is just kind of saving your own money. Maybe you're getting a sub 2 or something, but you're still putting kind of your own money in. Once you go from 3 to maybe 15 or 20, I can speak personally. I just did a refi of about 20 houses of mine, and the powerful thing about that was that I pulled out about 100. I think it's good to give like specific numbers. No one ever gives real numbers, right? So I just want to give you the numbers of this to see what you just described, right? Now let me put it into real life. I pulled out, I had 18 or 19 houses that consisted of 25 or 26 doors because some of them were duplexes. It was I refinanced it into like an $800,000 or $850,000 loan. And it gave me about $150,000 tax-free money, okay, which in the grand scheme of things doesn't do a lot right now in this market where everything's so expensive. However, it enabled me to do an $800,000 line of credit. So now it gave me a checkbook for $800,000 of money that I can go and put on a quadplex, a 20 unit, a warehouse, whatever I want to do with it, right? And that's where that leverage starts to be. I'm not, that 800,000 isn't coming out of my back pocket of savings, right? So now I'm able to use the equity in those properties as then the down payments on new properties, right? So it's not money I saved. I don't have to go and flip 5 houses to do that. I now am tapping into the equity, but I'm not paying taxes on any of it because I haven't sold anything. Okay. So it's important to understand, but it took me 18 houses. Now I could have done it maybe sooner, but it took that long to kind of get the equity going, enough cash flow to justify pulling out 150 grand because now my mortgage payment went up a little bit. So the rents had to go up enough to be able to still cover that and pull the money out and have access to that line of credit. So just so that you can see real numbers in a real life scenario where that happened. Now, if we want to go into a fund structure, which is what we are in the process of right now, we are living, breathing into being able to talk to the person that is really, really good at what they do in their day job, whether they're a doctor or they're a McDonald's worker, I don't care. But they understand investing in real estate is a good idea. But all the things that we talk about all the time, like, I just don't understand it. I get it, but I want someone else to do it. And that's where we're in the process of kind of raising money to be able to do what we're really good at in terms of buying properly in the best neighborhoods, renovating properly, getting it rented out properly so that everything is a nice stabilized asset, right? And so we are basically doing that right now. And it's something that we're learning a lot, and it's exciting because you start to see the 20 houses that I had personally go to, like I said, 40 or 60, because it's much easier because we're putting in a little bit of our money and then we're raising money through folks that don't want to go through all that blood, sweat, and tears. Is that what you're kind of seeing on your end, David, in terms of being able to kind of keep the compound effect from going from 2 houses to 3 houses to maybe 10 houses to 20 to what the next step is?
Yeah, it's a great summary. That when you get to that level of expertise, that you can start to genuinely raise capital on the basis of your skill set. So when you hear the bigger names out there in real estate and they're like, oh, I just bought another 200 unit, or I just bought this, they're almost entirely using OPM, other people's money. And there's a lot of guardrails in there, a lot of protections for the investors, but a lot of protections for the operator as well. And so when you're buying your first 3 deals, that's all on you.
Right.
You when you're buying your first 10 deals, again, it's just all on you. It's like there's nobody else taking the risk, if you will, and there's nobody else taking the upside. And so it is very, very common for investors to get to around 20 to 30 homes in exactly that strategy, because once they get those first 3, 4, 5 out of the way, then they start to build some equity, and then they get from 5 to 10. And then at a certain point, they kind of never really have to save again. They just have to regurgitate equity that they're creating
Right.
all the time, simply because they own these things long enough. And in a previous episode, we did a deep dive into the concept of using debt, holding things over time, and doing it in enough scale to free yourself financially. And then the next step, where in some ways you genuinely can scale beyond your wildest dreams, with essentially no money down, is by setting up a fund or setting up a syndication or setting up a JV scenario where you provide the skills and the expertise and the strategy to help people who have capital but they don't have the time, or they don't want to own a portfolio of properties because their spouse or they themselves don't want to be dealing with 5 or 10 different property managers every month, and all of the
Guilty.
insurance getting cancelled, or this happening or that happening. Administratively growing a portfolio beyond 20 homes starts to get starts to feel a little bit heavy because there's quite a bit of admin involved in that.
Yeah.
And so, you genuinely, once you get into setting up funds and syndications, you usually have those systems down pretty well. And so I hope we're going to end the episode here. Clark, I hope the takeaway here is that you do need money. There is money available. There is programs available. There is strategies available. But fundamentally, at the core of it all, you need to have personal financial discipline to save or to create new skills for yourself so you can save more, get into a higher paying job, get into a higher paying activity, set up side hustles, upskill yourself, buy a business, rent out a room, rent out your property. All of these things, you should have a real sense of urgency to get those first 4-5 deals done. And then the snowball just starts to compound on itself. So as we go out the door here on this one, growing your portfolio from 10 to 20 is pretty easy, right? You don't really have to save all that much anymore. You have equity in your deals.
Yep.
But growing your portfolio from 1 to 3 is really hard. 1 to 5 is pretty hard. And it requires discipline, it requires action taking. It requires you having the stones to go find a deal, present it to people who do have money, getting the deal done and taking your cut and saving that money towards your first house, second house, third house. I don't think there's a total shortcut to this. Clark, as we go out the door here, what's your takeaway?
There's 2 takeaways that I want to give. Is number 1 is there is opportunities, as we alluded to in the beginning of this conversation, in this country. There is money out there for you to buy your first house or your 50th house or anything in between. However, it is not going to fall in your lap and just say, hey, here's a bunch of like easy free money. You have to do 2 things. You have to take action and you have to be uncomfortable. So if you're standing in a room on a Thursday night at 6:30 p.m. where normally you just be at home eating dinner, watching TV, and that means you're taking action. Number 2 is if you're nervous, when you raise your hand and say, hey guys, I need some money, well, you're in the right damn room, right? Because you're taking action, you're uncomfortable, you're out of your comfort zone. If you do those things, you will make it happen. I promise you. But it may not be the first time, it may not be the second night, but eventually if you keep doing those in consistency, you will be able to raise money. And the last thing I challenge is, and I forgot to mention this earlier, is one more. Here's a pro tip, right? Let's say you got no money, no credit, all that stuff. You want to get into real estate. You're listening right now and you're like, I don't have $100,000 or $20,000. I have no network. I have no friends that have money. Cool. Go on Zillow. Go find a house that looks a little dated. It's for rent. Call the owner. It really needs to be a listed for sale rent, for rent by owner. Call the owner and say, hey, I want to rent your house. Would you be okay if I paid for all the repairs? And see what they say. And if they say, well, you just created every landlord's dream. Wait, you're going to be a tenant. You said that you've been paying the same amount in your last apartment or wherever you lived. And if you're able to have that discussion with them, then you get to do what's called a lease option. Okay. Which means I have the option to buy for X that you agree on. You're fixing the problem of the landlord because you are going to be vested in that property because you're going to ultimately buy it and they don't have to do any maintenance. So I challenge you that if you are just at the very starting point with no money, no credit, there's still a way to reach out to landlords on houses that maybe don't show the best, maybe they're a little dated, maybe they may need some future renovations, and say, hey, I want to solve all your problems. I still want to pay you rent. Just give me the opportunity with a low down payment or even $1,000 or $1,500 to get in to a path to home ownership. I've done it 3 times with 3 people that never would have owned a house otherwise. And now they are full-time homeowners that own something free and clear. So I will leave you with kind of a high level 10,000 foot mindset takeaway. and then just an easy way, not an easy way, it's a hard way. It requires you, again, to pick up the phone, be uncomfortable, having a different discussion that they weren't thinking about, and thinking again. I'll leave it with that, David.
Very good. I hope we've had great takeaways here for everyone. We hope we created value. Please remember, it's a big deal for us if you would kindly subscribe to our podcast so that you get these episodes delivered straight to your podcast platform. And we'll see you next time. Thank you so much for your time.
Thanks, guys. Talk soon.
You've been listening to the Burn Your Boats podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats podcast on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you for listening.